Let's dive into the topic of the moment, digital infrastructure. So before we start the next panel, another slide that further highlights the seismic shift being caused by the AI revolution. Last year, data center building made digital the record holder for total yearly spend in any sector in Infralogic's history, reaching $226 billion in the United States. Simultaneously, power, renewables, and core energy investments all reached new heights, with renewable energy investment in particular reaching $150 billion. We continue with the future of AI-ready infrastructure. Could 2026 outstrip a record year? This session looks at how AI is reshaping digital infrastructure as an asset class. Moderating is James Dodsworth, partner at White & Case. James, over to you.
Thanks, Jonathan. So, yes, we're going to talk about principally data centers associated with the scaling up of the digital infrastructure relating to the AI boom, for want of a better word. My name is James Dodsworth. I'm head of data centers at global law firm White & Case. And then we've got a fantastic panel here for you today. I'm basically going to ask them all to introduce themselves briefly, and then we will dive straight into it. So, Stephen, over to you.
Good morning. Name's Stephen Sonnenstein. I'm a senior managing director with Digital Bridge. I head up our global tower practice, sit on the investment committee, and do also focus on some of our adjacent strategies like land aggregation, outdoor digital infrastructure, and things of that nature.
Sure.
Hi, pleased to meet you all. See if you can hear me. Sean Yajnik. I head our Macquarie Capital's digital infrastructure, investment banking, and advisory group for the Americas region.
Hello, everyone. Nice to meet you. I'm David Strauss, co-founder and principal of BSP Technical Advisors. We conduct technical due diligence for investors primarily around fiber, cable, copper, networks, fixed wireless, and for the past couple of years, we've been focused on data centers as well. Happy to share the stage with Digital Bridge, one of our best clients. So,
thanks, David. So let's just get down to the basics. AI is driving tremendous investment. It's driving scale in relation to digital infrastructure primarily. And that scale is adding to the complexity that we see in the asset class. That complexity can take various forms, whether it be multiple stakeholders, challenges in the context of structures and financing. And I just wanted to start the conversation by asking each of our panelists how that scale and complexity is manifesting itself in the context of their own experiences and day-to-day jobs. Stephen, you start.
Sure. So it's really interesting. Conservative estimates suggest that the amount of capex spent for AI-related investment is somewhere in the range of $4 trillion between now and 2030. And then, some of the more aggressive estimates go all the way up to $8 trillion. So if you just think about that in and of itself, the quantum of capital that's going to be required in order to actually fund all of this development is kind of staggering. You take all of the pension funds in the world, there is enough of that money, but that would also mean that they would take all of their capital and put it into just one subsector, which arguably doesn't make sense. So I think where the complexity lies is in finding the capital to start, but the other thing that should not be ignored is the power or the access to it.
And when we talk about capital, we've obviously got the equity as well as the
equity, debt, and everything in between.
And everything in between.
Right, so it's a massive quantum of cash that's going to be required in order to build out all the commitments that people are making, have made. If you look at, just some of the large AI developers, they've each estimated somewhere in the vicinity of $1 trillion each of spend for AI over the next couple of years. It's massive. It's a massive amount of capital that's expected to be deployed into this subsector. But and that's just on the AI side, but if you look at the ecosystem as a whole, it's not just that. You need interconnection, you need the power, you need to acquire the land, you need the equipment that needs to go into this, you need the people to actually build these things out. There's a shortage. There's a shortage of all of this right now, and it's a mad race, and we're racing against other countries around the world or other geographies, and we'll see who wins. It'll be interesting.
So, Sean, is there enough money in the world to meet everyone's ambition? And to the point about the global nature of this, every country is competing with each other, particularly when you start talking about sovereign AI.
We could print it.
You stole my joke. No, that's right. Look, I think, no, there's not enough capital today to fill the full, $8 trillion estimate. But when you talk about new investments, one also needs to be mindful of exits as well. And that's sort of that recycling of capital is really going to be a big area of focus for the industry the next couple of years. Not necessarily complete exits, but a rotation of capital, recycling of capital, value recognition at the very least. And the solution to the complexity is likely going to be over time an ability to find a path in which large data center or even fiber infrastructure assets have sort of carved a way in which investors who came in 3, 5 years ago, 10 years ago, have a way in which they could exit and then come back to the sector as and when needed. As far as complexity of structuring goes, I mean, look at data centers alone. If you have one of the more dominant tools these days is really JVs and formation of SPVs, where you have multiple parties getting together, putting together the capital, different parts of the cap stack, and putting together the different capabilities and expertise to put in place to develop these large gigawatt, multi-gigawatt type facilities. And that's all well and good. I'm sure you're going to talk about the AI bubble and what that, what kind of risks that poses. So again, in order to participate in the sector, you need to embrace complexity with both hands. If you're not okay with that, it's going to be a very tough, gig for you for the next couple of years or more.
And, as technical advisors, the complexity that we're seeing is, of course, around solving for, multiple priorities around, land and power, and then, of course, fiber, which is some people don't necessarily pay as much attention to connectivity. We're a little biased in thinking that's a very important part of the equation. And then, forecasting to ensure that facility is AI ready, going out 5, 10, 15 years. That's awfully complex and challenging as well.
Yeah. So obviously, as this asset class develops, it's growing incredibly quickly. The scale that we've seen, really up to 1 gigawatt, but even more than that in terms of campuses, really just in the recent past is phenomenal. Are the structures and the way that we finance these platforms and individual assets changing as well? Do you have sort of a view on that and where that may be going as well?
They're getting more expensive. Here's the reality: is that we were starting to see some stresses in the market, right? Like, if you look as recently as 12 months ago, the natural buyers for a lot of these mega data center platforms were the likes of Fortress, Blue Owl. They were the ones that were sort of touted as going to be the ultimate. I wouldn't call them off-takers, but let's say next owner of these developed assets. And both of them have come under tremendous pressure recently in the market, as you've seen. Questions around some of the hyperscalers, their creditworthiness and so on, as they continue to build out. You're seeing campuses being built that have one customer. That's generally not a great diversification of risk. I think the one thing that people aren't focusing on is who's that next owner, and the contract duration with a lot of these campuses. If you're going to go build a gigawatt campus, and no offense to anybody in the room in South Dakota, once the training occurs and you move to inference, what's the utility of that data center, that gigawatt campus in, let's say, South Dakota for this example? And you go, you build it, you own it, you're holding it for 5 to 7 years. It's maybe a 10 or 12-year lease. That's going to be a tough sell. And the next ownership of it is going to ask themselves a lot of questions. So what's going to happen is, it'll get sold, but probably not at the cap rate that the original developers assume they might go and fetch.
We'll come on to confidence off the back of insolvency or restructuring of certain assets in a minute, but was just hanging on to the point about this, who are the ultimate purchasers of these very large assets and platforms, and it's a dwindling number of people or countries or governments or whatever it is. Sean, you've got insight into the M&A landscape. What are you seeing at the moment?
I think creativity is going to be key. Gone are the days when you can assume that the package of entities that was acquired is going to get exited in the same exact, proper, pristine way. I envision a world in which you start parsing out certain assets, putting assets in different pools, maybe constructing the right combination of yieldcos nested in within that certain development opportunities where you can get a nice accretion of stabilized cash flows over time with growth and not just a boring 3% yield, 3% grower. So I think just stepping back a bit and getting more creative on the right permutations and combinations of assets to put together before you put it out to market to sell or list or what have you is going to be key. What I would love to see, perhaps in partnership with Digital Bridge at some point, is to explore the public markets and really unlock this what seems to be the artificial sort of cap on leverage, right? There seems to be, the public investor universe seems to be very averse to looking at, to pricing, data centers which are above a certain level. I'll keep the level to myself, but I think it's maybe time for the public markets to be more open to higher leverage assets that have great equity value potential. Look at these long-term, well-rated, off-takers, attractive capital structures. Securitization market should be one which is better embraced by these public investors, and you might see a world in which you have multiple IPOs on the data center side. But the only way that can really happen is if leverage is less of a constraint. And importantly, investors need to sort of maybe perhaps step back, public investors, from the myopia of looking at things on a quarter-over-quarter basis and appreciate the fact that these value creation opportunities really realize over years and not quarters or weeks. So that might be in the medium or longer term, that may be another way in which you could unlock exits and monetization opportunities, right?
Mm-hmm. My reaction to that is ugh. The public markets are, as a private equity investor, you want to be able to, exit the assets, or your assets quickly. A public market exit could take, 3-5 years to sell off, and then you're subject to market, public market volatility. I totally agree with you on the leverage point. It's an absolute disaster. The leverage levels that we have in our assets is not, 5 and below. It's 5 and above. And
multiple times that.
I'm being polite. And the public market investors do not have an appetite to see 10 times leverage, 15 times leverage on some of these development assets. Now, and they also don't look at a business that has a pipeline 5 years out that is fully booked up. Yeah. But I do think, just to touch on that, I do think the natural owner of these assets is not the fortresses or the Blue Owls, but rather public pension funds or very long-dated sovereign wealth funds. However, I don't think they're the acquirers of these assets in the current contractual framework that they reside in. Pension fund is not going to enter an asset 5 to 7 years after it's been built when there's only 3 to 5 years remaining on the contract, on the lease. That just doesn't work for them. So if the industry and us are going to be able to figure out a way to get one of the hyperscalers to sign up to a 15, 20, 25-year contract, and hopefully not in South Dakota, maybe in a better geography that's more suited towards the needs of the market, that is something that would get built, may not fetch the same return, but would definitely allow for the capital to get deployed, sold, and then that capital to get reinvested, and continue growing the platform and growing the market.
I mean, let's just explore the institutional investor side of it, because obviously Digital Bridge has been very successful at bringing in that kind of capital. you have managed to do that, notwithstanding that the leases are not at those lengths yet, notwithstanding to the point that was made earlier that we don't really have a very diverse set of hyperscalers, either in number, geography, or nature and characteristics. And yet, you've managed to do it. Do you see that continuing, therefore, and actually morphing into the mainstay of where the equity comes from, and the debt, maybe?
Will we be able to continue to raise capital? Yes. Will it be from the same suspects? To be determined, uncertain right now. We've deployed a lot of capital into very successful platforms. I think our challenge has been that these platforms have become very, very big. Some of our smaller data center businesses are generating almost $1 billion of cash flow, of EBITDA. That's a big check. So, is one buyer out there able to do that? Yes, no, maybe. Look at the most recent large transaction that occurred in the market between, you got Aligned, you had AirTrunk that got done, and Blackstone put together a massive amount of capital for that deal. It's huge. There's, how many Blackstones are there in the world, right? So there's only so many of these checks that can be written at the end of the day. And the hyperscalers do not want to necessarily be the owners of this infrastructure because it's inconsistent with their strategy, right? So it's a big question mark. I do think that the long-dated, long-duration type investors that have patient capital, that have whose obligations and liabilities are long-dated, so pension funds, as I referred to, could be the natural owners of these, provided that they're the high-quality assets that they're looking for. Remember, at the end of the day, and I keep coming back to this example, building a data center in the Dakotas, which has maybe access to power and land, but may not be the right place where a hyperscaler is going to want to own or develop data center capacity beyond an initial period of 10 years becomes problematic. And my question is, who's the next owner of that asset? And what happens to the people that put the money in first? Are they going to get their money out?
Okay, so let's deal with the elephant in the room, the bubble that the media is very keen on talking about.
Yeah, it's coming. Look, if you add up the aggregate spend of all the AI developers and you divide that by each of their respective annual gross revenue, the payback periods are anywhere from 30 to 50 years. That's generally not a great ROI, in my opinion. So what...
And yet, we still see all these investors coming in.
Yes, we do, because people are making bets on who the winner is going to be, but I think somebody at the end of the day is going to be left with the dinner check. And it's going to be really interesting to sort of see how that plays out. I do have concerns. Is it a bubble? I mean, a lot of people are talking. I do believe that there is a race. I do believe there will be winners and losers. It's about choosing, who's going to be the winner. Is ChatGPT going to become like the new, call it Google of AI that everybody uses? Is Gemini going to be it? Is it Claude? I think Claude's, making massive leaps and bounds on the, on the finance side of things. Like, we use them. We use all of them, actually, just to be clear. We don't have one preferred, but we use them all for different things. You're going to see specialization, I think, of AI platforms. Ultimately, some will be used in more, certain industries versus others. But the amount of revenue that needs to be generated off of each of these individual platforms relative to the capex spend is quite scary. It's a very large number. If somebody says they're going to spend $1 trillion on capex developing an AI engine, great. And they're doing, I don't want to say any names, but they're doing, I don't know, $20 billion a year in revenue. Like, that's a 50-year payback. That's not great.
And David, just to bring you in here, in terms of the physical infrastructure.
Sorry, 200 billion. Anyway, the point I'm trying to make is that for the numbers to work, it would mean that every single user would have to be paying multiple platforms at once. And that's a real question mark. It's like saying, how many people have 3 different cell phones with 3 different carriers? They don't. Well, at least not in this country. But you get the point I'm getting at.
Well, it's demand and supply, I suppose, is really what you're saying. Yeah. So to talk about, in this context, the actual physical infrastructure, with all this frenzy of development, are you seeing real issues in the context of long lead and connection and
Well, I mean,
actually
we
delivering?
all know that, as it relates to reliance on the grid, local utilities, that can be awfully challenging. And of course, the behind-the-meter solutions that folks are pursuing as well. So I think that's, the number one concern that folks have. With regards to the fiber element, it's a matter of money, frankly, and resource to build. It's that's not the long pole in the tent, so to speak, right? So that's not the real challenge. I want to pick up on, the hyperscaler comment in that, we have another large client who I'm not going to name, but Stephen named earlier, who's asking us to look at the tenant fit-out, ability of 3 different enormous facilities with names as tenants. And, it was said on an earlier panel that the due diligence is going deeper than it's ever gone before, and I think this is evidence of that, to ensure that the specs that tenant has are met to the T by the facility itself. I mean, that's a key component. I'm assuming from an investment perspective, each of you are very concerned about the risk associated with that. But then also, to Stephen's earlier point is, 5, 10, 15 years down the road, in an earlier panel, it was said that today's GPUs will be obsolete. Well, they're still usable. They're not necessarily obsolete. But what is their value in 5, 10 years' time? What's the value of that fundamental infrastructure itself? Those are key calculations that should be made to the best of one's ability in terms of forecasting, in a 5, 10, 15-year time horizon, what will be the true value of that to the market. So, I don't know.
Maybe
Go
to
ahead.
add, when we talk about the AI bubble, I think it's helpful to think about that in the context of timing, or what period of time is that going to crash if it does, and the extent of the bubble bursting, right? I think we've learned a lot from the few different bubbles, booms and busts we've seen the last couple of decades. The GFC, before that, the internet, bubble, and in the middle we had an intermediate sort of a tech bubble. So there are lessons learned. It seems to me like, as you think about this further out in the future, what really are the workloads and what are the AI use cases that all of this infrastructure is trying to support? Is it really going to be Gemini, Claude, and these app-based platforms that we use to generate code or generate the ideal vacation setting, or is it something that we haven't really imagined or seen yet? And if agentic AI is really what the end state is, that may be the get out of jail card for all of the incredible amounts of capital that is going in here. The problem with that is that the risk premium you need to ascribe to workloads and use cases that haven't quite been identified yet, leave alone that, you don't even know what kind of a revenue model that's going to have relative to the amount of capital that has gone in so far, does pose an optical challenge of what the yields today look anemic. Again, as I said in my opening remarks, if you don't like complexity, this is not the sector for you. There is a good amount of leaning in and leap of faith you need to have in the future of the AI use case going forward, and sort of step away from just what we do today. And and hate to be philosophical here or too poetic, but imagine a world where the AI use cases are way more advanced and do truly become part of what each one of us does on a daily basis, right?
They will. They already are. I mean, we're going to hire half the analysts we have in the past. All the investment banks are going to replace all their analyst programs with AI bots. No, I'm just kidding.
No, Macquarie is still very much actively recruiting guys. So.
But I suppose this is the point. When we talk about a bubble, we're not talking about the end of digital infrastructure. That's here to stay. It's part of the infrastructure of the global economy and indeed most societies. It's actually just a valuation correction.
Correct. Totally.
Right.
But there's one thing that people aren't talking about, right? Which is, at the end of the day, AI is going to reside here. It's not going to reside at a data center. So we're all talking about data center development and data center build out, but before it gets from, for it to get from there to the our handsets, which is where AI will live. You need to build out your networks. You need to build out the fiber, the towers, the edge compute. You need to build out the power so that power is delivered. Our grid capacity is not capable of running 24/7 uptime right now. Our grids are overloaded, and we need to invest massively.
With a time delay that
wow, it's going to take time. How long does it take to get a CCGT plant permitted, or dare I say nuclear in this country? There are other countries in the world that have nuclear, small to medium reactor capacity and capability. So they have an edge. They have an advantage over this country that's, still afraid of nuclear. But we need to build out everything, because at the end of the day, the networks that we have today are not suited or capable to handle the AI workloads that are coming. And then, quite frankly, 5G is great, right? Ubiquitous coverage, seamless, zero latency, download, not upload, right? And AI is going to rely tremendously on censoring, and this is one thing that's coming. That'll be 6G, right? The censoring technology that all of these AI devices are going to rely upon need to reside and transit over massive network build-outs that don't exist yet, right? Take the Meta glasses that are out. You see the new ones with the visual screen and the lens. I mean, they're sick. They're really cool. But how many people are using them right now? Just a handful. Imagine you had 1 million people in a city using them.
We haven't even talked about driverless cars and all the rest of that. Compute power.
A driverless car, a self-driving car generates about 12 terabytes of data a day, right? So that has to be communicated, uploaded, stored in a data center, and reviewed and be available for compute, for use, for so on. So, the amount of spend, we talk about $4 to $8 trillion. That's data center development. What about everything else? It's another couple $1 trillion right there. So, the amount of money and power that's going to be required is massive.
David, you were nodding enthusiastically when Stephen was talking about
the fiber piece. I mean, is it a recent event where 2 data center operators, the last question of the panel was, what do you see happening in the next few years or next 5 years that no one sees coming? And these 2 data center operators literally said the size of the pipes. The pipes are too friggin' small, right? And it was interesting to hear that from data center operators. So that's a key concern that Stephen speaks to that we all need to be conscious of. That.
So this is a natural break on the accelerated growth. What you're saying is you have to dig it up, you have to build it better, you have to build a grid. Doesn't this mean that the demand supply is actually managed such that we don't get a bubble?
Well, it's gated.
Yeah. Okay. I'll just say it depends on everybody in this room and how quickly we adopt it and we use it. Is everybody going to use AI quickly or demand it, require it? Are the applications going to, the bots get developed so fast that we are going to take them and incorporate them into our daily lives so much so that, it's going to be a catch-up, or are we going to temper the demand? I don't know.
Yeah, just repeat your point that sometimes constraints are a great filter for quality. And having, power constraints, having fiber build constraints, having quality of contract constraints, having a constraint of the number of IG off-takers there are, broadly speaking, does push the industry towards really scrutinizing and scrubbing ourselves on who really deserves the capital, who really deserves that, piece of financing that is otherwise stretchy. So again, to your point, I think there's a natural sort of an ecosystem interlock of some level of checks and balances where you have, off-takers, you have the data center operators themselves, you have OEM and equipment providers, and you have lenders and equity providers. I think I listed 5 or 6 participants in this ecosystem where at any point in time, when 1 or 2 run really hot, one would hope that the others are natural checks to them. I forgot to mention power providers, of course, right? So I think that's a 6th prong in my sort of envisioned flywheel of checks and balances. And one would hope, as people who wish to see this industry thrive in a measured, in a risk-adjusted fashion, that this flywheel of checks and balances of these 6 participants in the ecosystem are functioning well, and are from a regulatory standpoint as well, are well supported from Washington and each of our states. And that's, I think, the natural check is what we have to look forward to, right? There's no other way. Otherwise, yes, you're right. We're heading into a crash if everything is easy, money is cheap, equity is cheap, plenty of power available, and there's less discipline around what kind of deployments should you really be pursuing.
Any suggestion that there'll be more regulation from government?
I have
to
no
deal with any of
suggestions.
Oh, no, no, no. I'm not touching that one.
Nice try.
So, given the amount of capital we've been talking about, the scale of things, by definition, this is truly going to have to be an international industry. It already is a massively international industry. You tend to find when markets become saturated that the industry migrates to other undeveloped areas of the world where perhaps there's greater risk reward. That's not happening for various geopolitical reasons and others, but I'd be interested for your various oversights on that.
It can't.
But also where the demand is, right? It wouldn't make sense to develop these kinds of infrastructure, components out somewhere where the end users aren't really, out there trying and testing and experimenting with what's latest in AI. So I think financial capital is perhaps global, but where you deploy these infrastructure assets they're also global, they're very selective, right?
So I'm going to throw something into the mix, but go on, Stephen.
No, well, it's not only that. Like, building on what Sean just said, there's a data sovereignty question, and call it, U.S. dependence on compute that the world is sort of moving away from. Europe right now, several countries in Europe are trying to develop non-U.S. Powered data center capacity. Countries want data to reside within their jurisdictions. In theory, we should go and build data centers in north or wherever there's massive amounts of renewable hydro and so on. But no American is going to want their data computed abroad. It's just not something that's right now the world is ready for. Unfortunately, it's going to create a lot of redundancy and a lot of duplication of infrastructure assets. It's not synergized. But the challenge that you're going to face is access to these types of grids and networks that are sound enough and pipe that is large enough in order to provide the compute that people are going to be consuming.
So just throwing into the mix then, sovereign AI. So this is for the broader audience, the requirement for governments around the world to develop their own AI models and engines with the assistance of the hyperscalers and, in some cases, Western capital and Western DC platforms and expertise. It's different to what has happened before, but it is definitely something that is already happening and is going to continue to develop. What do you think that's going to take the industry? And can you say whether you're involved in that already, Stephen?
The answer is yes. The problem is it's not going to work because the people that are trying to develop these sovereign-related AI platforms or data center capacities abroad don't have the capital. They don't have the money. How do you go, look at the hyperscalers. They have hundreds of billions of dollars of cash. They can build data centers wherever they want. If somebody in a certain country decides that they want to swear off all of, US-based hyperscalers, it's going to be very challenging. It's not impossible, but I think it'll be very challenging for them to achieve that. So, what happens is you're having people like us and like many of our competitors will develop sovereign data center capacity in a foreign jurisdiction, and we will attempt to source the equipment based on the specs that the end customer wants. But, NVIDIA's GPUs still remain top of the market. Can we go and use other GPU developed technology? Yes, absolutely. But with that comes, increased risk on reliance, dependency, speed, effectiveness. NVIDIA is not going to remain the only GPU provider forever. There's other capacities that are being developed, some here, some abroad. So
and is that a direct challenge to the neo-cloud model, do you think?
No, I think it complements it. It's not proprietary in nature. It's just there's going to be other alternatives that are going to allow people to to be able to build out their capacity. The problem that you have is that you don't need that. You could build all the data center capacity in one country and it could serve an adjacent country, but people don't want that. You know, the Americans are never going to allow all of their data center capacity to be built in Canada or Mexico, and then send a fiber back to the U.S. That'll never work. Same thing in Europe. In Europe, you have 30 countries. They all want to have their own data domiciled within their borders.
Well, the other challenge is, cheaper energy, right? So if there's cheaper energy in the Nordics, I mean, you see that happening and the Nordics reacting. So I think that's an interesting trend as well.
Particularly on the back of the scale we've been talking about, if it gets bigger and
You
bigger.
know, as cheap energy, space.
We haven't even touched on that.
And South Dakota, but
Is that,
And South
is
Dakota.
that even realistic in, say, the next couple of decades?
Absolutely.
No.
Make no mistake. The only challenge you have is the distance, right, and the latency. You can do all the training up there. You can't do inference from space, but it's, endless power, endless cooling. It's perfect. It's a great environment. Just have to work out the radiation thing a little bit, but otherwise it could work.
no problem, yeah.
David,
No.
have you been involved in any of the...
Nothing involving space as
space
of yet.
No.
It's all land-based.
Yeah.
Terrestrial data centers.
Let's just briefly touch on Neo Cloud before we wrap up. This is an element of the market that is very hot. It's accelerated from almost nothing. It's to some the fuel on the fire that is, accelerating the lack of discipline potentially in the market. What are your respective views? Because it does seem to divide opinion in terms of whether it's a good thing, bad thing, agnostic.
You go first.
We want to dodge that one.
What do you mean?
In the context of new participants that are essentially akin to hyperscalers, but they're not hyperscalers, they're not taking the same length contracts as hyperscalers.
like
But people are
enterprise
still
colo.
building and developing very large capex projects off the covenant. And
Like
off that.
NeoCloud?
Yeah.
Oh, yeah, for sure. Look, it's funny. NeoCloud can be akin to colo data centers, right? Which saw their growth. Some succeeded, some failed, but a lot of the colo providers have migrated into hyperscale data centers over time. I think the NeoCloud is a real opportunity for alternatives to the hyperscalers. NVIDIA's backing a very large number of them, and it does offer greater accessibility, I think, to the market, broadly speaking.
Yeah, I do believe that AI needs to be and continues to be democratized, and the way to do that is through the NeoCloud route. Of course, there are questions around business model viability. Not all NeoClouds are built the same. They're not all financed the same. They're not all contracted the same. So of course, those are questions that need to be asked, and that will go down pretty quickly in the next 3 to 5 years. I think you'll know who the winners and losers are in the NeoCloud space, but they all have a right to exist, and they all have the right to make money. Our team, our group is relatively bullish on enterprise co-location and edge data centers as well. We don't think that all the value and the low discount rates need to apply only to hyperscale data centers. There are a whole host of tier 2 and tier 3 edge locations in the Midwest, in the Southeast, and the Southwest of the country, which are fantastic areas to generate real alpha for equity investors. And they don't have to be, gigawatt-sized facilities. They can be, 50 megawatts, 30 megawatts, even 10 megawatts. I think those dots of excellent data centers everywhere will be a great way to promulgate the inference phase of AI, and they'll be increasingly more scarce, especially with NIMBYism, as you're seeing, in various political sort of pockets. And you physically and technologically need them to exist and thrive in many of these overflow markets. So we're pretty bullish on that.
Mm. And I guess you raised an important point, which is it's not all about AI. There's still cloud, there's still enterprise, there's still any number of business streams that are driving material sums
Totally.
of money in the market.
Yeah, I think the non-AI, the cloud, related sort of workloads are still thriving and was growing really robustly until AI came and just put a cloud over everything else. Pardon the pun. But I think it's not just even within AI, right? So there's two types of inference workloads. One is which is latency sensitive, and the other is which is latency insensitive. It doesn't really matter if it takes a few extra milliseconds, even a few more seconds to be helpful. That TAM of inference with an AI that is not latency sensitive is pretty meaningful. Right? Think about a research project that takes 20 minutes to get done. You don't care if it's 20 minutes and 1 second, right? Or 10 seconds. Those use cases are really well served by these slightly more further out edge to tier 2 and tier 3 locations
I'm moving.
within the AI context, but you cram in their HPC compute capabilities with attractive PUEs, and you have a really nice portfolio of smaller deployments, more rational, less capital constrained, capital consuming relative to the big ones, but they are still riding the AI wave in a different way. Right?
I'm moving.
So, by way of wrap up, if I could ask you each to sort of summarize, where you think the market is at the moment, and really what's going to happen
Just give me a minute.
over the next, say, 18
Wait,
months.
no,
Let's
keep
keep it
it there,
relatively
waiting
short
for
term.
this to finish.
What should the audience be thinking about and looking out for?
2
Well,
minutes.
I mean,
this
I
will
want
be
to pick
finished.
up
You
on
can keep
something
going.
Sean said vis-a-vis
Don't
the
let me
colo
stop you.
facilities, as well as edge. I mean, the demand that we're seeing from our clients would indicate that, those continue to be robust. I know some have predicted the demise of colo facilities, but that doesn't appear to be the case at all. So as much as we focus this conversation on the hyperscalers and the impact of AI, those segments within the data center sector are worthy of attention and focus. And let's not forget the size of the pipes too.
It's the media that really focuses on
That's right.
the big ones.
That's right.
Yeah. I think the next 18 months will be very interesting, even outside of the hyperscale data center sort of space that we've all been following very closely. I think there's a lot of work and consolidation to be done in the fiber to the home space and the residential or the consumer broadband space, be it platforms buying each other out to enhance scale, or it could be in some kind of a combination of HFC networks combining with something else. That we didn't even touch upon that. That's not quite AI related, although there are some penumbras of AI tailwinds in that space. But that I think is going to be a very active market going forward. We're personally spending a lot of time on wireless infrastructure, not just macro towers, but also small cells and in-building wireless, which we think is going to be another great way in which folks can access the ever-increasing need to have ubiquitous and high-quality data. And as I just mentioned, the enterprise colo / private cloud space continues to be one which is certainly interesting. Not everybody has a great asset, but those who are great I think, has a great opportunity to sort of wedge that gap between, the mid-market funds, for example, or even the upper mid-market funds will find themselves quite busy in that area where they don't have to spend billions of dollars to, chase large establishments.
Stephen, you get the last word.
I think it's where one should focus is really on everything in the ecosystem aside from the AI data center development. It's the suppliers, it's the equipment that you need, the generators, the chipsets, the servicing related to building out these facilities, the energy development, the grid connect, the grid reinforcement, and building out everything from the data center all the way to the user. Because if we don't build all of that, we can build all the data centers in the world. They're going to sit there. They won't just be able to feed the market. So that's really where I think focus needs to be. And he touched on it. He's right. Towers, small cells, in building. We don't stand outside and next to a cell tower. We're constantly on the move. If we don't build out these networks, it's not going to work.
That's right. David, Sean, Stephen, thank you very much for your time.
Thank you.
Hello, everyone, and welcome back.
Ooh, why is that? That's not cool. Shit. Oh, come on. What? Excuse me?